Goa is overrated. And I'm not saying it, your Instagram feed is saying it. Your colleague who just got back from Bali is saying it, and your neighbor who flew to Phuket with their family for less than what a long weekend in Goa would have cost them is most definitely saying it. India is traveling more than ever before, and they're in love with international destinations. Vineet and I are part of that too. In 2024, 3 crore Indians made international trips. It was 10% higher than in 2023, and they're taking multiple such international trips each year.
So does that mean hotels in India aren't full? And they're struggling to get people through their doors?
Well, to understand hotels and tell you whether these stocks deserve a place in your portfolio, we are going to tell you 3 things in this video. Number 1, how does a hotel actually make money? And what are the numbers that you should be tracking? Number 2, are hotels in India actually a proxy for India's travel boom, or are you buying something else when you invest in them? And number 3, the bull case and the bear case. Should you be excited about hospitality stocks right now, or is the best already priced in?
Welcome to T-1, a video series by Zerodha Varsity. In each episode, we'll explore the biggest trends shaping India's industries to help you make smarter investment decisions. We focus on the big picture so you can better understand the forces that truly move the stock markets.
So, the first thing we need to understand about the hotel industry is all the jargon. And if you don't know what RevPAR, ADR, and occupancies mean, you won't understand hotels. So, Vineet, you're going to break it down for us, please.
Okay, so imagine a hotel has 100 rooms. By the way, there's another jargony term for rooms, and it's called keys. Rooms are called keys. On a given night, 70 of those rooms are occupied, and the average rate paid by each guest is rupees 8,000. Your occupancy is 70%, and your average daily rate, or ADR, is 8,000. But the RevPAR, or revenue per available room, is simply the occupancy rate multiplied by ADR. So 70% of 8,000 is rupees 5,600. That single number, RevPAR, tells you how efficiently a hotel is monetizing its room inventory. Not just how full it is, not just how much it charges, both together.
And this also means that the average daily rate, the ADR, sometimes we might even call it the average room rate, by the way, the ARR, it's almost always higher than RevPAR, because ARR only looks at the rooms you sold, while RevPAR looks at every room in the building, whether someone slept in it or not. In RevPAR, the cost of empty rooms is being spread across the total revenue.
And RevPAR is quite an important metric to track, because a hotel can make the ADR and occupancy look optically good. You can fill every room by slashing your rates to rupees 2,000 a night. Your occupancy looks great, your revenue looks terrible. Or you can charge rupees 20,000 a night and have half your rooms empty. RevPAR adjusts for all of that.
Got it. But rooms are only part of the story, right? Because every time I've stayed at a hotel, I probably visited the restaurant. I probably had a drink at the bar. So there's F&B revenue that gets added to the top line too.
Exactly. A hotel's revenues comes from broadly 2 buckets. Rooms on one side and F&B, or food and beverage, on the other. Restaurants, bars, in-room dining. And among India's listed hotel players, this actually makes up about 30 to 40% of overall revenues too.
But explain one thing to me, Vineet. When I look at the reports of many of these hotels, and I'm going to take the example of chalet hotels over here, I see RevPAR growth at close to 13%. But the revenue growth for the hotel business has risen by 23%. So explain that to me.
Okay, so one way to explain this is new rooms are being added, which leads us to revenue growth. But another major factor is MICE, meetings, incentives, conferences and events, and weddings too. These massive events fill banquet halls and drive massive F&B spend, which shows up in the top line but not in the RevPAR.
Got it. And as per Shwetang Singh, the CEO of Chalet Hotels, he told us there's EBITDA, or the earnings after all operating costs, but before interest and depreciation and taxes. That is a key metric too.
Look, at the end of the industry, at the end of the day, the whole industry, and especially a company like ours, works backward from value creation. And if you look at value creation for us, valuation that getting on the stock market, that is typically linked to the EBITDA. So let's say EBITDA is the tracking number. EBITDA a lot of people put too much emphasis on what margins it has come at, etc., etc. But at the end of the day, it's the value that you take to the bank and not the margins percentage. So EBITDA becomes our key metric, and EBITDA against the capital that we have employed. So it is called return on capital, right, or ROCE, which is the key metric that we look at. So against let's say a capex of 100 rupees, if you're using an EBITDA of 20 rupees, then that's a 20% ROCE. And that ROCE is what then forms the base of our performance.
So, to summarize the metrics, total revenue for the full revenue picture, including rooms and F&B, RevPAR for rooms efficiency, EBITDA and ROC to understand how well the earnings are translating into returns. And now we have to talk about how a hotel is actually run. Because when I think about a hotel, I would imagine that they own all these grand properties, right? The big buildings, the fancy chandeliers in the lobby, everything. But there are other ways to run a hotel too.
The way the hospitality model works in the same form is that there is an owning company and then there is an operating company. So Chalet started off as an owning company, and the operating company in our case was anybody who we tied up with, like a Marriott, an Accor, a Hyatt, or whoever. And basically, the brands that you see on display for the consumer comes from these companies.
To build on what Shwetank said, there are three distinct models that have emerged from that owner-operator split. The first is owned and operated. The company owns the land and the building, runs the hotel staff itself, keeps all the revenue, bears all the costs. High capital commitment, high risk, but also high potential upside when things go well.
And historically, Vineet, this is what India's largest hotel groups typically did, right? They built these massive iconic properties, such as the Taj Mahal Palace in Mumbai, or if you take the Oberoi, for example, the Oberoi Amar Vilas in Agra next to the Taj Mahal. They own them all outright.
Exactly. But building and owning a hotel is enormously capital intensive. You're talking hundreds of crores just for one property. And all that capital locked in bricks and mortar that takes years to generate returns. So the industry has been moving towards management contracts. Here, the hotel company doesn't own the property at all. A third-party investor owns the building, the hotel brand comes in, runs it, handles operations, staffing, marketing, reservations, and charges a fee. Typically, a base management fee plus an incentive fee linked to profitability.
The most preferred is obviously a management contract model where brand does not invest any sort of money in the property. They take on the operation of the property and do the distribution. There's a fee on the top line, which is called as a base fee. And then there is a GOP base fee, which is the operating fee. This is a preferred model.
So, the hotel brand is essentially selling its name and its operational expertise, but not its balance sheet, right? Lower risk, asset light, scalable, and you can sign 50 management contracts without borrowing a single rupee.
And then there's a third model, franchising, which is even more hands-off. The hotel company licenses its brand and its operating standards to an owner-operator. They pay a franchisee fee, follow the brand's guidelines, and run the property themselves. Hotels won't like this comparison, but it's what the biggest fast food chains in the world do, right? The brand sets the standards, the franchisee runs the outlet. And the advantage for the franchisee isn't just the name on the door.
If you're say for example, taking a Marriott brand, let's say 4 points on franchise, then that would mean that your hotel at 4 points would be bookable on their website, and most importantly, would be tied to their loyalty program, in this case a Marriott Bonvoy program, which essentially gives you an edge over some of the other brands slash or operating it yourself. So that then becomes a franchise model.
And it looks like models where the capital isn't tied up are gaining preference now. For the Taj Group, 68% of the rooms or keys in operation today is capital light. 8 years ago, it was just 22%. And in the pipeline of nearly 30,000 keys, only 6% will actually be owned by the group. For the Oberoi, right, which prides itself on the hospitality and wanted to control each of its hotels, of 90 new hotels to be completed by 2029, 11 will be an asset-light model. And Lemon Tree is even undergoing a full structural reorganization by splitting the company into two. Their owned hotel assets transfer to a separate listed entity called the Fleur Hotels, while Lemon Tree Hotels itself becomes a pure asset-light company.
So as an investor, you can bet on an asset ownership model or asset light model separately. Besides Lemon Tree, however, most hotel companies are looking to find a healthy balance of both. But asset light or not, whether a hotel property will be successful or not largely depends on one factor, and it's location, location, location.
See, everything to do a hotel is a location. So, like people, too many people would have said location, location, location is the important element to decide a hotel. If you have a hotel which is at a right location, at a metro, say at the airport, or where demand is flowing, probably say BKC, you're not worried for next 2, 3, 4, 5 decades, whether that demand would be there or not. So if you have a right sort of location, hotel can be a perpetual asset. Good part about hotel product is, unlike other real estate segments where there is a lock-in of the lease rentals for a period, maybe 5 years, 7 years, or 3 years, where escalation kicks in. Hotel, you can revise the rate anytime you want. Uh, I'm sure you've heard about this AI summit happening in Delhi, and rates got escalated. There were news that some hotels were charging as high as 1 lakh rupee per night. So that is a good factor when it comes to hotel.
Okay, so we know how hotels make money and we know the different shapes and sizes these companies come in. So let's get to the big question. Is international travel hurting Indian hotels? We told you right at the start of this video that in 2024, over 3 crore Indians traveled abroad. We are spending over $30 billion on international travel. And this is rising year after year. That's an enormous amount of money leaving India. Money that, in theory, could have been spent at a hotel in Jaipur, Goa, or Coorg. Also, international travelers visiting India, it hasn't even gotten back to pre-COVID levels yet. So there's an impact there. So if you own shares in Indian hotels or Lemon Tree or Chalet, should you be worried?
Here's the thing, Nitin. The intuition that outbound travel hurts listed Indian hotel companies sounds right. But just look at the number of listed hotel companies. Your Indian hotels, your Chalet hotels, or your Lemon Tree, they are reporting record high growth. They are printing money quarter after quarter. And despite all the noise you hear about holidays in these exotic locations, domestic travelers are driving the boom here.
And I get it. We are 1.4 billion of us with a rising disposable income and aspirations. So it looks like there is plenty to go around domestically too. And if you have heard of Kapil Chopra of Postcard Hotels, he was at the Oberoi before that. And he made a very interesting point in an interview. So when Oberoi set up its luxury hotel in Udaipur in 2004, it had 8% occupancy only from Indians. But by 2018, that number had become 52% from Indians alone. And we spoke to Kapil Malhotra, a totally different couple, who manages a hospitality-focused portfolio at Tata Mutual Fund, and he put things in perspective about foreign visitors.
Indian hospitality sector has, to a large extent, decoupled, from the international arrivals and spending. So, for example, right, 25% of revenue used to come from international travelers pre-COVID, which now has become 20%, right? This is despite of the fact that the revenue for a lot of these hospitality companies have grown at a great pace and growth rate. Despite of that, you do see that the contribution by these guys have come down significantly, at least in a meaningful way. So yes, there is truth to that statement, but this is also actually reflected in the number of monthly air passengers within India. So, for example, Jan 20 data, if I give you, right, this number monthly air traffic passengers used to be around 12.8 million per month, which has now reached around 15.2 million, as per the latest data. So what that means is, of course, the domestic demand has been extremely resilient.
But of course, there is no denying that there is a threat of foreign travel here. And when we asked this to Shwetank of Chalet, he was quite honest in his admission.
I think the problem is not coming from the hospitality. The problem is coming from the fact that the experience is not holistic outside. So you may go to a brilliant hotel and have a very, very good experience. But once you step out of the premises of the hotel, there are museums to go to, there are no zoos to go to, there's no sort of holistic experience around the around your holiday, and that sort of not keeping people happy. And when you go abroad, you tend to get a more holistic experience from right from the airport, in the hotel, and surroundings, etc. So I don't think that's an issue. So that issue is coming from the fact that experience is not complete. And whilst earlier there was a price arbitrage between India and, let's say, Southeast or Dubai, that price arbitrage has disappeared, but the numbers are so close that clearly these destinations are an option. So we are not denying that option is there. Our belief is that not only is the base of people increasing, all people where people used to take one or two maybe one holiday in a year, trend has changed to multiple holidays. And when you take multiple holidays, you will tend to choose destinations. And India for Indians will certainly be exciting. There is, of course, the psychological barrier of 6 hour flight, which is Southeast Asia. Whatever the requirements are, even though they're it's becoming easier every day, but you still need to have a visa. And the fact that there is food and beverage, the quality of hospitality that Indian hotels offer is still very hard to replicate. Although Southeast Asia does a good job, I wouldn't say that. But if you Dubai and towards the western, it's not as warm as the Indian hospitality. I think it's more cut and dry. So when you put all of it together, we don't see that as a reason that we will suddenly run dry of domestic tourism.
Now, even if we set that aside, there's one reason why many of these hotels won't be worried. And here's something I saw in a post-earnings call by the Taj Group. So, 53% of revenue comes from key domestic business cities, 15% from domestic leisure destinations. So the core customers aren't the ones going on big holidays. Rather, it's the corporate business travelers or the executives flying into Mumbai, Bengaluru and Delhi for meetings. And there's a MICE segment, which you mentioned earlier too, Vineet, right? And weddings as well in this. None of these are going to Bangkok instead. And Nikhil Shah put it in the most memorable way we have heard across all our conversations.
MICE has become one of the important contributor to the business. These hotels, I usually, when I talk to my clients, I tell them, if you are in a metro city 2 hours away, you should make a shadi khana because the business is amazing. And in terms of events, a lot of events are happening.
So to put it simply, weddings and MICE aren't just nice to have revenue for listed hotel companies. They are increasingly the primary engine driven by India's aspiration to celebrate loudly and expensively and at 5-star hotels.
Although there is a caveat here, as Kapil pointed out.
Destination wedding, right? Corporate events, and similar unique experiential offerings. They give an edge to the domestic tourism, right? These are extremely difficult to replicate outside India, right? So these are one of the factors which are keeping the domestic tourism, resilient. But having said that, given where the Southeast Asia ARRs sit today, they put an upper cap, to the ARRs of the cities in our country, and hence they can't exponentially keep going up.
Okay, so putting it all together, growing revenues from MICE, higher demand from domestic travelers, and a steady pipeline of supply suggest that things are looking up for India's hotel industry. And if that is the case, let me lay down the bull case for the industry and then Vineet will present his bear case. So firstly, India is still dramatically under-hoteled relative to its size and has fewer branded hotel rooms per capita than virtually every comparable emerging market.
India would roughly have 250,000 branded inventory. If you compare China is like 2.5, so which is 2.5 million, which is like 25 lakhs. So we are, 1/10 of what China is.
So the listed players with established brand equity are better positioned to capture that growth, especially those operating in the upscale or the luxury segments. Number 2, demand is structurally outpacing supply. On the face of it, you might think there is an oversupply of hotel rooms in the market. That's when you see bits and pieces from reports such as one by Horwath HTL, a hospitality consultant, which said that 2025 had the largest annual supply addition on record for India's hotel industry. Over 19,000 rooms were opened. But Kapil gave us a nuance that put things into perspective here too.
So I think, hotels across India are, of course, signing up new projects at a rapid pace for sure, right? For example, in FY25 alone, about 45,000 rooms were signed, right? On an existing base of around 1,96,000 or say probably 2 lakh rooms. But I think you need to get into the nuances of it. Actual addition are only about 15,000 rooms per year right now, right? So the pipeline is large, right? What we've already signed up around 115,000 rooms on a base of around 2 lakh rooms uh, under construction, but commissioning essentially of these rooms will spread over the next 5 to 6 years. What that translates into is that this pipeline build-up is gradual rather than front-ended. It is actually back-ended. Lot of this pipeline is actually will start coming online from FY 29-30, right?
And then, when I show you this chart by Juniper Hotels, you'll be able to rest more easily knowing that demand growth is indeed outpacing supply. 3. The operating leverage is improving. ICRA is forecasting operating margins of 34 to 36% for listed hotel companies in FY26. This is up dramatically from the pre-COVID era where it was 20 to 22%. Higher ADRs, better occupancies, and moving to an asset-light model, all of these contribute to the numbers looking better and better. So, Vineet, over to you now for the bear case.
Okay, firstly, we spoke so much about MICE plus weddings driving hotel revenues. The biggest driver of corporate travel and MICE in India is the IT and financial services sector. And both of those are staring at AI-driven disruption. We covered this in detail in our IT episode. Go watch that if you haven't already. But for hospitality, the short version is that immediate job losses and a broader slowdown in hiring compresses the white-collar workforce over time. Fewer IT employees means fewer people flying into Bengaluru and Hyderabad for work. Fewer mid-level managers means fewer corporate offsites. The entire pipeline of business travel that feeds premium hotel occupancy in India's tech cities runs through these companies. Second, revenue growth is normalizing. ICRA revised its sector outlook from positive to stable, signaling a normalization of revenue growth to 6 to 8% in FY26 after years of double-digit growth post-COVID. The easy gains, the recovery trade, the pent-up demand, the revenge travel, those are largely done. If investors are still pricing these stocks for that earlier era of explosive growth, the reckoning will come in the earnings. The third thing to keep in mind is valuations. Even within the industry, the valuations range widely. IHCL, for example, its P ratio is currently around 45 times. Chalet, however, is 26 times. And the industry as a whole is largely around 35 times. And Kapil gave us the most direct investor guidance of anyone we spoke to.
We believe these hotels will essentially trade at a multiple which is similar to where they are trading today. So we don't believe that these multiples will correct significantly. I think what one important factor as an investor you need to be watchful of is that margins currently, right? As we are in an upcycle, margins are currently near peak levels or in extremely high levels because of a positive operating leverage which has worked for these guys, right? And supply pipelines are currently building, right? So that means chasing rallies at elevated valuations, of course, can be risky. So, obviously, the smarter approach for an investor or for any fund manager, of course, is accumulate during cyclical corrections, right? Cyclical corrections, which is like the one you have currently underway, right? Rather than buying at the top. Of course, it's very difficult for a retail investor to watch that. But you need to be watchful of it, right? For example, a lot of these hotel stocks have price corrected and time corrected in the last 2 years, right? Someone getting on the top essentially would have had a painful journey in terms of the stock price returns, right? So, Indian hotels as a sector do deserve a premium versus the international peers, but you have to be watchful of the valuations and where we are in the cycle, right?
And that is the end of yet another T-1 breakdown. We hope you've enjoyed learning about the hotel industry in India, and let us know in the comments whether you're feeling bullish or bearish on hotels. And we'll see you soon in the next episode.